U.S. existing home sales hit 9-month low in June. Analysis. The U.S. housing market is sending out distress signals. Existing home sales slumped to a 9-month low in June, painting a stark picture of a sector grappling with high mortgage rates and a shaky economic outlook. This downturn raises a critical question. Is this a temporary blip or a sign of deeper economic trouble brewing? But here's where it gets controversial. While some experts believe this is a localized issue, others fear a ripple effect across the broader economy. After all, the housing market, though representing less than 5% of the GDP, has a significant impact through related industries like furniture, appliances, and construction. A prolonged slump could trigger a domino effect, impacting consumer spending and overall economic growth. What do you think? Let us know in the comments. Existing home sales fell by 2.7% in June, landing at a seasonally adjusted annual rate of 3.93 million units, the lowest since September 2024, according to the National Association of Realtors, NAR. This figure falls short of the 4 million units predicted by economists polled by Reuters. While sales remained flat year over year, the trend clearly points downwards. This decline wasn't uniform across the country. Sales dipped in the Northeast, Midwest, and the heavily populated South, but interestingly, they actually rose in the West. This regional variation begs the question, what factors are driving these opposing trends? And this is the part most people miss. The housing market's sensitivity to interest rates is a key factor in this downturn. The average rate for a 30-year fixed-rate mortgage has stubbornly hovered near 7% this year. This high-rate environment, coupled with general economic uncertainty, is keeping potential buyers on the sidelines. The NAR report reveals that properties lingered on the market for an average of 27 days in June, a noticeable increase from the 22 days a year ago. Adding to the complexity, the supply of existing homes increased by 15.9% year over year, reaching 1.53 million units in June. This translates to a 4.7-month supply at the current sales pace, up from 4.0 months a year ago. While a 4 to 7-month supply is generally considered balanced, the current situation reflects a combination of both low sales and increased inventory. This raises a crucial point. Is this truly a balanced market, or is it a sign of weakening demand masked by a still constrained supply? The median existing home price reached a record high of $435,300 in June, a 2% increase from the previous year. However, data from Redfin reveals a more nuanced picture. National house prices grew by only 3.4% year over year in June, the smallest increase in 2 years. Furthermore, 30 out of 50 metro areas experienced month-over-month price declines in June, with cities like Tampa, Austin, and Dallas even seeing annual price drops. This divergence between median price and actual market trends warrants further investigation. Is the record median price a true reflection of market health, or is it skewed by specific segments of the market? The percentage of first-time buyers remained relatively stagnant at 30%, up slightly from 29% a year ago. A healthy housing market typically sees first-time buyers comprising around 40% of sales. This underscores the challenges faced by new entrants in the current market. Despite these challenges, distressed sales, including foreclosures, remain low at 3% of transactions, a far cry from the 30 to 40% seen during the 2007 to 2009 Great Recession. This suggests that, while the market is facing headwinds, the underlying fundamentals are arguably stronger than during the previous crisis. Do you agree? Share your thoughts in the comments below. The current housing market slowdown presents a complex and multifaceted challenge. The interplay of high interest rates, economic uncertainty, and regional variations creates a dynamic situation with potentially significant implications for the broader economy. The coming months will be crucial in determining whether this is a temporary setback or a harbinger of a more protracted downturn. What are your predictions for the future of the housing market? We encourage you to join the conversation and share your insights in the comments. Home sales crash while prices hit record high. June housing report breakdown. In a shocking turn of events, The real estate market in the United States has seen a significant dip in June home sales, despite prices reaching unprecedented heights. This unexpected development has left many wondering what factors are contributing to this sudden shift. Imagine this. You're in sunny Los Angeles, California, where the real estate scene is usually buzzing with activity. But as of late, there's been a noticeable slowdown. High interest rates and a sense of economic uncertainty have cast a shadow over the once booming housing market. It's not just LA feeling the chill. The entire Southern California region is experiencing a similar cool down. According to the latest figures from the National Association of Realtors, sales of pre-owned homes plummeted by 2.7% in June compared to May. This translates to a total of 3.93 million units on a seasonally adjusted, annualized basis. Economists had anticipated a much milder decrease of only 0.7%. When we look back at the same period in 2024, sales remained steady, showing no change. Now, let's delve into the numbers. These sales figures are based on completed transactions, which means that the majority of these contracts were likely inked during April and May. During those months, the average rate on a 30-year fixed mortgage hovered around 7%, occasionally dipping but never falling below 6.8%, according to data from Mortgage News Daily. Lawrence Yun, the chief economist for the NAR, has pointed out that the persistently high mortgage rates are the culprits behind the stagnant home sales. In a recent statement, he suggested that if the average mortgage rate were dropped to 6%, there could be a surge in the number of first-time homeowners by approximately 160,000. Additionally, this could lead to a boost in sales activity among existing homeowners. Despite the lack of movement in mortgage rates over the past few months, they've remained stubbornly high due to concerns about the overall health of the economy. Currently, the average rate stands at 6.77%. As for the housing inventory, it's gradually increasing, with 1.53 million units available for sale at the end of June. This represents a 15.9% jump from the previous year and corresponds to a 4.7-month supply at the current sales pace. However, it's important to note that a balanced market typically has a 6-month supply, indicating that the current situation still leans in favor of sellers. Prices continue their upward trajectory, with the median cost of a home sold in June reaching $435,300. This marks a 2% increase from the previous year and sets yet another record high for the month of June. It's worth mentioning that this is the 24th consecutive month of annual price hikes. Yin attributes the soaring home prices to the ongoing undersupply of properties, coupled with the sluggish pace of new construction relative to population growth. This combination is particularly challenging for first-time home buyers trying to enter the market. On a brighter note, Yin also highlighted that the average homeowner's wealth has grown by $140,900 over the past 5 years. Interestingly, the trend in sales varies across different price segments. Homes priced below $100,000 saw a 5% annual decline, while those in the $100,000 to $250,000 range experienced a 5% increase. However, it's the luxury segment, with homes priced above $1 million, that witnessed the biggest jump, soaring by 14%. Properties are now taking longer to sell, averaging 27 days on the market compared to 22 days in June of the previous year. Yet, higher-end homes are finding buyers more quickly than those priced below $500,000. First-time buyers made up 30% of all sales, a figure historically lower than the usual 40% share. Meanwhile, all-cash deals continue to dominate, accounting for 29% of sales. Before the pandemic, cash purchases constituted around 20% of the market. On average, each listing received 2.4 offers, a slight decrease from 2.5 offers last month and 2.9 offers a year ago.